The brutal economics of owning an apartment complexa. 200-unit apartment complex charging $2,000 per month can look like a money machine. At full occupancy, that sounds like $400,000 in monthly rent. Nearly $5 million a year before adding parking, pet fees, storage, laundry, or other income. From the outside, the model seems almost unfair. People always need somewhere to live. Rent arrives every month. The building may appreciate over time. And unlike a restaurant or retail store, the product cannot simply disappear from fashion overnight. That is the picture. Here is what the picture leaves out. Not every unit stays occupied. Not every tenant pays on time. Some tenants move out with almost no notice. Some apartments need thousands of dollars of work before they can be rented again. Insurance rises, property taxes rise, payroll rises, utilities rise. Repairs arrive when the owner least wants them, and the mortgage still has to be paid whether the building is full or half empty. An apartment complex is not really a rental business. It is an occupancy, debt, and operating cost business where every empty unit immediately stops producing revenue while most of the expenses continue. The building creates capacity. The leases create income. But occupancy, collections, and cost control determine whether the property becomes a strong investment or a slow financial drain. Before the economics make sense, the different apartment models have to be separated. A garden-style suburban complex may spread units across several low-rise buildings with surface parking, landscaping, and shared amenities. A mid-rise or high-rise building can place far more units on a smaller land footprint, but elevators, structured parking, fire systems, and mechanical infrastructure can make the property much more expensive to operate. Luxury apartments depend on premium finishes, amenities, and a customer base willing to pay for them. Workforce housing focuses more heavily on affordability, function, and location. Student housing has concentrated leasing seasons and different turnover patterns. All of these properties collect rent. They do not have the same economics. The first major decision is therefore not what countertops to install. It is what renter profile the property is designed to serve and what that renter is actually willing to pay. Now comes the first major misunderstanding. A 200-unit property is not really 200 identical revenue sources. It is a collection of separate leases. One unit may rent for $1,800, another may rent for $2,100 because it was renovated, another may be vacant, another may be occupied but delinquent, another may be under repair and producing nothing, another tenant may be paying below market because the lease was signed before rents increased. The owner therefore does not manage one rent number, he manages a rent roll. That rent roll tells him what every unit should earn, what every unit actually earns, when each lease expires, and where revenue is leaking. This is why gross potential rent and collected rent can be very different numbers. Now consider location. People want access to jobs, transport, shopping, safety, and daily convenience. A strong submarket can support higher rents and lower vacancy. A weak submarket may make a property look cheap to buy while remaining difficult to operate. A complex near growing employment can benefit from new demand. A complex in an area losing population can struggle even if the apartments themselves are perfectly acceptable. This is where inexperienced buyers can get trapped. A low acquisition price does not automatically mean a good deal. Sometimes the property is cheap because the future income is weak. Now imagine the simple calculation again. 200 units, $2,000 per month, $400,000. But if occupancy falls to 94%, 12 apartments are empty. Those 12 units produce zero rent, the landscaping still needs maintenance, the parking lot still needs lighting, management still needs to be paid. Property taxes do not fall because 12 tenants moved out, insurance does not disappear, the mortgage does not shrink. This is why occupancy is one of the first operating levers in multifamily ownership, but physical occupancy is only the beginning. Suppose 96% of the units are occupied. That sounds excellent. But what if several tenants are not paying? What if many leases were signed with 1 month free? What if some residents are paying heavily discounted rents? The building can look full and still underperform financially. This is the difference between physical occupancy and economic occupancy. The owner does not pay the lender with occupied apartments. He pays the lender with collected cash. Now add turnover. A tenant leaves. The apartment has to be inspected, cleaned, painted, repaired. Maybe the carpet needs replacement. Maybe the refrigerator is broken. Maybe the bathroom needs work. Then the unit has to be photographed, listed, shown, and leased again. During that process, it earns nothing. The owner is spending money on an asset that is temporarily producing zero revenue. This is why turnover can quietly destroy returns. One move-out might not matter. 30 or 40 move-outs across a year can become a major expense. Strong operators therefore track not only how many tenants leave, but how long each apartment remains offline before the next tenant moves in. The faster the unit turns, the faster revenue returns. Now think about the acquisition itself. Buying an apartment complex means buying both real estate and an operating business. The buyer is not only purchasing walls, roofs, and land, he is purchasing a stream of future cash flow. That means the buyer studies occupancy, lease expirations, rent collections, payroll, repairs, utilities, taxes, insurance, and something called net operating income. NOI is the income left after normal operating expenses but before debt service and income taxes. This number matters because apartment values are closely tied to the income the property can produce. If NOI rises, value can rise. If NOI falls, value can fall. That means a small operational improvement can have a larger effect than it first appears. A modest rent increase across 200 units matters, reducing vacancy matters, lowering bad debt matters, controlling insurance matters. Apartment economics are built on repetition. One lease is small, 200 leases become a financial system. Now consider what a marketing brochure rarely emphasizes. The new owner may inherit every problem the previous owner postponed. Aging roofs, old HVAC systems, parking lots that need resurfacing, plumbing issues behind walls, outdated common areas, worn appliances, poor drainage, deferred exterior maintenance. Buying the property does not erase those obligations, it transfers them. This is why due diligence matters so much. A complex can produce attractive cash flow today while quietly carrying millions of dollars of future capital needs. The owner is buying an income-producing machine, but he is also buying every worn-out part inside that machine. And that is the first brutal economic reality. Before the first post-acquisition rent payment reaches the bank, the owner may already be committed to vacancy costs, repairs, payroll, insurance, property taxes, and capital projects that can completely change the return. Now the revenue side becomes more interesting. Rent is the foundation. But rent is not the only way a large apartment property can earn money. Parking can be charged separately. Residents may pay pet rent. Storage units can be rented. Laundry can generate income. Utility costs may be partially reimbursed. Some properties charge for reserved parking, premium units, package services, or certain amenities. Each category may look small by itself. Across hundreds of apartments, small charges compound. But the most important number is still not the advertised rent. It is the effective rent. Suppose an apartment is listed for $2,000 per month. If the owner offers 1 month free on a 12-month lease, the real economics are lower than the headline number suggests. If management pays a leasing commission, offers a gift card, or discounts the first few months, the actual revenue falls again. This is why a property can advertise aggressive rents and still collect much less than investors expect. Now consider leasing velocity. When a unit becomes vacant, how quickly can management make it ready? How quickly can it be photographed? How quickly can it be shown? How quickly can a qualified tenant sign the lease? Every unnecessary day is lost revenue. An empty apartment is perishable inventory. Yesterday's vacant night cannot be sold tomorrow. This is why strong operators obsess over make-ready time. A maintenance delay is not only a maintenance problem, it is a revenue problem. Now add resident retention. Keeping a reliable tenant for another year can be extremely valuable. The property avoids a vacancy period, it avoids cleaning, it avoids repainting, it avoids marketing, it avoids the uncertainty of the next tenant. This creates a difficult pricing decision. Raise rent too little and the owner leaves revenue on the table. Raise it too aggressively and a good tenant may leave, creating turnover cost and vacancy. The best decision is not always the highest possible renewal increase, it is the increase that maximizes long-term economic value. Now consider amenities. A pool can help justify higher rent. So can a fitness center, a clubhouse, a dog park, outdoor lounges, package rooms, co-working areas. These features can make the property easier to lease, but every amenity becomes another operating responsibility. Pools need chemicals, cleaning, and repairs. Gyms need equipment. Clubhouses require heating, cooling, and cleaning. Landscaping has to be maintained. Package rooms need systems. The feature that helps raise rent also creates another expense line. This is a recurring pattern in multifamily ownership. Every revenue opportunity tends to create an operating obligation beside it. Now think about payroll. A 200-unit complex can require a property manager, leasing staff, maintenance technicians, and groundskeeping support. A larger or more premium property may add concierge services, security, or additional maintenance coverage. If the owner hires a third-party management company, the fee reduces NOI. If the owner manages internally, the work still has to be performed. Self-management does not make labor disappear. It simply moves the expense. Now consider maintenance. Every apartment contains dozens of things that can fail. Air conditioners, water heaters, refrigerators, dishwashers, toilets, faucets, electrical outlets, locks, cabinets, doors. One repair is manageable. Hundreds of units create a constant stream of requests, and multifamily buildings introduce another risk. One failure can affect several tenants. A leaking pipe on an upper floor can damage apartments below it. A central mechanical failure can affect an entire building. Maintenance is therefore not an occasional inconvenience, it is part of the product residents are paying for. Tenant. Now separate repairs from capital expenditures. A technician replacing a broken faucet is an operating repair. Replacing a roof is something else entirely. Parking lots, exterior paint, elevators, boilers, major plumbing, windows, HVAC systems. These costs may not appear every month. When they arrive, they can be enormous. This is why the owner cannot treat every dollar of current cash flow as profit. Part of today's cash belongs to tomorrow's building. An apartment complex can look highly profitable for years if the owner postpones major work. Then several capital projects arrive at the same time and expose how weak the economics really were. Now consider rent growth. Many buyers build an investment thesis around increasing rents. Buy the property, renovate apartments, improve management, raise pricing, increase NOI, increase value. The logic is powerful, but rent growth is not guaranteed. New competing apartments can open nearby. Local employment can weaken. Tenant incomes can fail to keep up. A market that supported large increases for several years can suddenly flatten. Even when higher rents are theoretically possible, pushing too hard may increase turnover. This is why market rent and achievable rent are not always the same number. Now add value, add renovation. Suppose the owner buys an older complex. He spends $15,000 renovating one unit. New flooring, better appliances, updated lighting, modern cabinets, fresh bathroom finishes. If the renovation allows the apartment to rent for $200 more per month, annual rent rises by $2,400. That sounds attractive, but the owner first had to spend $15,000. The unit may also have been vacant during construction. If the renter will only pay $100 more, the economics change. If competing properties force concessions, they change again. The renovation is not valuable because it looks better. It is valuable only if the additional income justifies the capital spent. Now imagine repeating that decision across 100 apartments. A small mistake in renovation economics becomes a very expensive strategy. Now add bad debt. A tenant can occupy an apartment while producing little or no cash. Collections take time. Legal processes cost money. Once the resident leaves, the unit may need repairs before it can be rented again. One delinquent lease can therefore create unpaid rent, legal cost, physical damage, and future vacancy. This is why tenant screening matters. The highest paying applicant is not automatically the most valuable resident. Reliable payment and reasonable retention can be worth more than a slightly higher advertised rent. Now consider insurance. The property is exposed to fire, storms, water damage, liability claims, and rising rebuilding costs. Premiums can increase quickly. The owner cannot simply stop buying insurance because the price became inconvenient. Then property taxes arrive. A sale can trigger reassessment. Local valuations can increase. Tax bills can rise even if the building itself did not improve. Unlike a broken appliance, the bill returns every year. Now add utilities, water, sewer, trash. common area electricity, exterior lighting, pool systems, clubhouse, HVAC. In some properties, residents pay much of this directly. In others, the owner carries a larger share. The difference can materially change NOI. Now the building begins to reveal what it really is. Not a stack of apartments collecting passive checks, a small operating company with hundreds of customers, dozens of recurring expense categories, and a physical asset that never stops aging. And every month, the operator repeats the same challenge. Keep the units full, keep the rent collected, keep the residents satisfied enough to stay, keep repairs under control, and keep expenses from growing faster than revenue. Now leverage enters the story. Most large apartment complexes are not purchased with cash. They are financed. That can make the economics far more attractive. A buyer may control a $50 million property with only a fraction of that amount invested as equity. If rents rise and the property appreciates, leverage magnifies the return on the investor's money. But leverage also magnifies mistakes. The lender does not care that 3 major tenants moved out this month. The lender does not care that insurance increased. The lender does not care that a boiler failed. The debt payment still arrives. This is why an apartment complex can feel extremely stable until the cash flow tightens. Now return to NOI. Suppose our hypothetical 200-unit property charges an average of $2,000 per month. At full occupancy, gross scheduled rent would be $4.8 million per year. Assume physical occupancy averages 95%. That reduces the rent that can actually be billed. Now subtract concessions, delinquency, and other collection losses. Then add parking, pet fees, storage, and other income. For illustration, suppose the property ultimately collects about $4.7 million of total annual revenue. These numbers are hypothetical, not industry averages. Now begin subtracting operating costs. Payroll, repairs, management, utilities, insurance, property taxes, landscaping, cleaning, marketing. Administrative expenses, routine maintenance. Suppose those expenses total roughly $2 million. That leaves approximately $2.7 million of net operating income before debt service and income taxes. The building is generating millions, but the owner still does not keep $2.7 million. Now the mortgage takes its share. Suppose annual debt service is $1.8 million. That leaves around $900,000 before major capital expenditures, taxes, and owner-level costs. A property producing $4.7 million of revenue has now become a much smaller amount of distributable cash. This is why gross rent is such a misleading headline number. Now imagine the optimistic year. Occupancy remains at 97%. Renewals are strong, turnover falls, bad debt stays low, the owner raises rents modestly, renovated units lease quickly, insurance remains manageable, maintenance stays under control. The local job market remains healthy. NOI rises because apartment values are often based heavily on NOI. The property can become more valuable without adding a single new unit. This is one of the most powerful characteristics of multifamily real estate. Improve the income stream and the asset itself may become more valuable. But now consider cap rates. A cap rate is one way investors compare property income with value. If buyers are willing to accept a lower cap rate, they may pay more for the same NOI. If cap rates rise, they may pay less. This means the owner can improve the property and still face weaker valuation conditions because the wider capital market changed. Interest rates matter. Financing availability matters. Investor demand matters. Apartment ownership therefore carries 2 different risks at once. The building can perform poorly, or the building can perform reasonably well, while the market values that income less generously. Now consider refinancing. Many investment plans assume the owner will increase NOI, refinance, and recover some of the original equity. That strategy can work extremely well when values rise and financing remains attractive. But if interest rates rise before the refinance, the new loan may be far more expensive than expected. If valuation falls, the owner may not be able to borrow as much. A strategy that looked conservative when the property was purchased can suddenly become tight. The apartment business is therefore not only about tenants, it is also about capital structure. Now imagine the bad year. A new apartment complex opens nearby. It offers 2 months free to attract tenants. Several residents leave. Occupancy falls from 95% to 89%. The owner responds with concessions. Economic occupancy falls even further. At the same time, insurance increases sharply. Property taxes rise. A major plumbing problem damages several units. Maintenance costs jump. The property still looks impressive from the street. Most of the windows are still occupied, but the financial machine is weakening underneath it. If annual NOI falls from $2.7 million to $2.2 million, that is not simply $500,000 less income. The lower NOI can also reduce the value of the building, and the debt does not fall with it. This is where leverage becomes dangerous. The equity absorbs the damage first. Now consider debt service coverage. The lender wants the property to produce more cash than the amount required for debt payments. If that cushion becomes too small, refinancing becomes harder and risk increases. The owner may be forced to inject additional capital. This is how a property that once appeared almost passive can suddenly demand cash from its investors. Now consider appreciation. Apartment owners often expect to earn from two places: cash flow while they own the building, and appreciation when they sell it. That can be a powerful combination, but appreciation cannot rescue poor operations forever. If the building constantly loses tenants, requires heavy capital spending, and carries expensive debt, rising land values may not be enough. The strongest investments usually combine three things: a good location, disciplined operations, and financing that gives the property room to survive weaker periods. When one of those breaks, returns weaken. When two break, stress increases quickly. When all three break at the same time, multifamily stops feeling safe. Now step back and look at the entire business. A 200-unit apartment complex may generate millions of dollars in annual rent, but the owner never truly owns the gross revenue. Vacancy takes its share, concessions take their share, bad debt takes its share, payroll takes its share. Repairs take their share, insurance takes its share. Property taxes take their share. Capital expenditures take their share, and the lender takes its share. What remains can still be extremely attractive, but only if the property was purchased at the right price, financed responsibly, and operated well. This is why experienced owners obsess over details that outsiders rarely notice: occupancy by unit type, renewal rates, average days vacant, concession levels, bad debt, turn cost per apartment, maintenance response time, expense growth, NOI margin, debt service coverage. They do not look at a full parking lot and assume the property is performing. They look at the cash. Now consider scale. A duplex can feel like owning a few rental properties. A 200-unit complex behaves like a company. It needs systems, staff, vendors, budgets, leasing processes, maintenance workflows, resident communication, financial reporting. Scale makes apartment ownership attractive because the same operating system can manage hundreds of units, but scale also magnifies mistakes. A bad leasing strategy affects dozens of apartments. A poor renovation program burns capital across the property. A badly structured loan affects every unit at once. From the resident's perspective, the business is simple: pay rent, live in the apartment, call maintenance when something breaks, renew the lease or move out. From the owner's perspective, every one of those decisions feeds into a much larger financial machine. The lease creates income, the vacancy stops it, the turnover creates cost, the operations preserve value, the debt magnifies the result. And in the brutal economics of owning an apartment complex, the most dangerous unit is not the one with the oldest carpet or the ugliest kitchen. It is the perfectly rentable apartment sitting empty while the mortgage, taxes, payroll, and repairs continue anyway. Would you ever consider investing in an apartment complex knowing that a property can look full, valuable, and stable from the outside while the real battle is happening inside occupancy, collections, expenses, and debt? Share your opinion in the comments. If you enjoyed this breakdown, like the video and subscribe to Business Unboxed for more stories about how the world's most misunderstood businesses actually make money.